DeWaal here, and this is Bridging the Week for June 15th to 19th, and today is June 22nd, 2015. Good morning. Last week, another Chief Compliance Officer was named in an enforcement action brought by a regulator, while a new type of wrongful conduct was identified in the financial services industry, causing quote-unquote atypical trading. I hope all you dads had a happy Father's Day yesterday, or just a great day generally. But it's now time to get going and cover last week's major developments. So, let's get started. The Securities and Exchange Commission filed two separate administrative complaints last week related to the misappropriation of client funds by the former president of an investment advisor. In one action, the SEC sued Brian Orand, the former president of SFX Financial Advisory Management Enterprises, for allegedly stealing client funds from 2006 to 2011. SFX was registered with the SEC as an investment advisor from 1992 through 2012. In the second action, the SEC sued SFX and Eugene Mason, SFX Chief Compliance Officer. The SEC charged Mr. Mason with causing SFX not to have adequate compliance policy and procedures reasonably designed to detect the theft by Mr. Orand. According to the SEC, during the relevant time, Mr. Orand wrote unauthorized checks from client accounts to himself. Without client approval, he also allegedly wired funds from such accounts to others as well as himself. According to the SEC, Mr. Orand stole in excess of $670,000 from clients. The SEC said that Mr. Orand was able to commit his fraud because SFX granted Mr. Orand full signatory power over client bank accounts. This was because the firm's compliance policies and procedures, quote, were not reasonably designed and were not effectively implemented to prevent the misappropriation of client funds, end of quote, the SEC said. The SEC claimed that as CCO, Mr. Mason was responsible for the implementation of these policy and procedures. As a result of this and other alleged violations, the SEC charged SFX with engaging in fraudulent conduct and failing to supervise Mr. Orand, as well as for not having adequate written policy and procedures designed to avoid violations of law. The SEC charged Mr. Mason with causing SFX to not have such policies. To resolve this matter, SFX agreed to pay a fine of $150,000 and Mr. Mason a fine of $25,000 among other sanctions. Mr. Orand's action is pending. I have a lot to say on this on the article version of Bridging the Week on the website. Check it out. The Commodity Exchange Inc. filed a disciplinary action against Mirrors Futures LLC, currently known as Ninja Trader Brokerage, claiming that on January 6, 2014, the firm failed to monitor the functioning and connectivity of its trading platform with CME Group's Globex electronic system. According to the exchange's notice of disciplinary action, quote, this failure resulted in unusually large and atypical price movement in the February 2014 gold futures market and prompted a so-called velocity logic event, end of quote. Generally, a velocity logic event occurs when the market moves a predetermined number of ticks up or down within a predefined time and prompts a temporary pause in trading. COMEX charged Mirrors with failure to supervise and conduct detrimental to the exchange. The firm settled with COMEX by agreeing to pay a fine of $200,000. Joseph Welch, a former broker for MF Global, agreed to settle charges by the Commodity Futures Trading Commission against him that from at least June 2006 through May 2008, he attempted to manipulate palladium and platinum settlement prices on the New York Mercantile Exchange. According to the CFTC, Mr. Welch engaged in such conduct on behalf of Christopher Pia, the trader for his client, Moore Capital Management, LLC. In a complaint filed in March 2012, the CFTC had alleged that, during the relevant period, Mr. Pia entered orders to try to increase the price of palladium and platinum during the closing period, which would impact the settlement prices. Mr. Welch handled Mr. Pia's orders. To settle this matter, Mr. Welch agreed to pay a fine of $500,000, never to trade any platinum or palladium contracts regulated by the CFTC, and to attend annual continuing education programs for 5 years that address abusive and manipulative trading practices. 36 municipal underwriting firms settled enforcement actions brought by the SEC related to their use of municipal offering statements that contained allegedly materially false statements or omissions. The SEC brought its actions under its Municipalities Continuing Disclosure Cooperation Initiative, announced in 2014, that offered favorable terms to municipal underwriters who self-reported security laws violations rather than waited for such violations to be detected. The SEC also charged the firms with failing to conduct adequate due diligence to detect their false statements or omissions. Among the firms paying the largest fines, $500,000 US, were Goldman Sachs, JP Morgan Securities, and Merrill Lynch Pierce, Fenner & Smith. In aggregate, the firms agreed to pay $9.29 million US in fines. The CFTC settled charges against Christopher Evans for executing 30 unauthorized bilateral swap transactions opposite a customer in order to hide trading losses from the customer and his unnamed employer from January through July 2013. The unauthorized trades were allegedly to have occurred from January through July 2013 and resulted in approximately $1.2 million US of trading losses. This is losses for the aggrieved customers. The customers were later reimbursed by Mr. Evans' employer. The CFTC charged Mr. Evans with general fraud, fraud by deceptive devices or contrivances, this is under the CFTC's new anti-fraud-based manipulation authority, fraud in violation of business conduct standards for swap dealers, and unauthorized transactions. In addition to paying a fine of $1.2 million US, Mr. Evans was required never to trade on or subject to the rules of any CFTC-registered entity, among other prohibitions. And finally, the Securities and Exchange Commission enjoined Sand Hill Exchange, an unincorporated business, and Jared Hall and Elaine Wu, who both ran Sand Hill, from selling over-the-counter security-based swaps to retail clients. Under the Dodd-Frank Act, OTC security-based swaps may only be offered to highly sophisticated or financially capable persons or entities known as eligible contract participants. Mr. Hall and Ms. Wu effectively ran Sand Hill as a securities exchange without required registration, beginning in February 2015. Thus, any transaction on the exchange was effectively an OTC transaction. The exchange effectively offered binary options linked to liquidity events, such as mergers, initial public offerings, and dissolutions, and to the value of private companies and their securities. In addition to ceasing their offer and sale of OTC security-based swaps to retail persons, the respondents agreed to pay a fine of $20,000 US. Well, that's it for this week's Bridging the Week. As always, there is more information in each article, and more articles on the article version of Bridging the Week on the website. Check it out. Until next week, this is Gary DeWaal. Have a great week, and ciao!